A sharp rally in peripheral Eurozone bonds, yields tumbling today on growing hopes that the European Central Bank will soon carry out large-scale bond purchases. German magazine Der Spiegel saying the ECB will set specific thresholds for yields and spreads. Well, let's get out now to Luka Jelinek. He's head of European rate strategy at Crédit Agricole in London. Luka, Spain 10-year is now 25 basis points from going below 6%. Do you think we'll see that this week?
I think it's entirely possible. As you know, it's already moved by a huge margin. At one point, we were playing around the 7% margin. And we actually have seen some flows. And of course, the news you mentioned is quite important.
So, sorry, just to say that again, you're seeing some real flows here into this. It's not just a question of short covering.
Well, I think it can be a combination of both. And I would say that a lot of the price action is magnified by the lack of liquidity in August. But there definitely is evidence of actual buying. Now, some of that could be short covering, but I think there's some real money too.
Okay, now all this or most of this seems to be on the Der Spiegel story over the weekend. First of all, is this likely, the ECB setting a threshold on yields? And also, does that fit in with their mandate?
Well, I think when you talk about the likelihood, it is rather problematic vis-a-vis the legal aspect of it. You could say that it's monetary financing. I think the reason the Der Spiegel story got so much mileage is, of course, it has been preceded by Draghi's statements, and more importantly, or as importantly, a number of comments by Angela Merkel in Germany suggesting that with the right kind of conditionality, under the right circumstances, the idea of a more open-ended commitment from the ECB could be palatable. But it is a big call, and it's not a done deal by any means. I guess our take, though, is that if it were a big call, if it was a done deal, you'd see the market tighten in much more than it has. You'd see moves in the hundreds of basis points rather than tens of basis points. So what the market is doing now, it seems to me, is saying there's a possibility of this. It's maybe not even a great possibility, but it's not trivial. Okay.
And what kind of levels would we be talking about here? A cap of, say, 300 basis points on the 10-year spread?
I think if they went for a cap, they might want to start with something even a little bit lower. The idea is that, and this would be a line of reasoning to justify a cap, is that the spreads, the difference in rates between real economy borrowers in places like Italy and Spain versus, say, Germany and France have continued to widen. So there is no monetary policy transmission, i.e. the ECB can cut rates and Italian and Spanish corporates would keep having to pay higher and higher yields. So the idea would be to lower those towards more French or German-like levels. Now, if you had that kind of convergence, you would have core rates rising. So you might want to set the spread tighter, probably more in the range of 150 to 200 basis points at the most.
Okay, and sorry, would that be the same for Italy as it would be for Spain, or would there be differentials there as well?
I'm not 100% clear about that, because I think that there's a sense in the ECB that Italy has done what it needs to do on the deficit front to a more aggressive extent than Spain has, and it's managed its conditionality, for lack of a better word, better. So it's not clear that it would be the same recipe for everyone. Okay, and just to finish up, you mentioned it earlier, it's not a done deal by any stretch, and today we've got the Bundesbank reiterating their opposition again. A lot more to go on this. Absolutely, and of course there's a lot of risk building up going into that September 6th meeting of the ECB. There's a lot of riding on that. Okay, Luka, thank you very much. That was Luka Jelinek at Crédit Agricole. That's all for now, but do watch us at this time every weekday for Market Pulse, a look at what's moving on financial markets and why. I'm Jamie McGeever. This is Reuters.